Now we get to pivot into Asia and more importantly, China. Now, for those that have been watching us, when you look at Chinese data, when you look at activity, and when you weigh what we've said on the Econ show as well as the EIA show, our view is that things in China were going to get much worse before they got better, and purely because of the way humans interact. And again, even if you have the government saying you can do whatever you want, how willing are people to do whatever they want? And it comes down to, the activity. So when you look at the drop in activity, it's actually the most severe it's ever been. And it's hard to see, but in 2022, when you had that drop, there was actually a slight slowdown. So this is actually the biggest straight decline that has happened since COVID started. So when you think about the congestion side, you have to consider, the Asian mindset. The Asian mindset is there's a lot of reverence for elderly, and not to say that us in the West also don't have a reverence, but it's different. There is definitely more of it. And when you look at some of the shifts, there's going to be a slowdown, because if you have the option of, okay, the government said I can go out, are you going to go tear it up at night and go to restaurants and bars knowing that there's a huge case count increase? Or are you going to try to be a little bit more cautious? And our view is like, look, even though the government is saying you can move, people still won't, for fear of an increase in infection rates, getting their family infected, especially as you come close to the holiday season, between Christmas, between Lunar New Year. Are you going to want to get yourself in a position where you're sick as you go towards the to see family? But as we know, all spikes fade. Now you have people that are going to have natural immunity. You're going to have spikes coming down. So this is something where, when you consider winter, this is going to be a big spike. It's going to weigh on a lot of things in Q1. And then I think really as you get into Q2, maybe March, more March into April, or April into May, you're going to get some of that snapback, and you're going to get some of that benefit as a lot of this reverses. But as we've shown in previous segments over the last year and a half, 2 years, even on reopenings, there's still not a lot of activity, because real estate is still terrible. Infrastructure is still not there. Global growth is slowing. So manufacturing exports are not there. And then the consumer is the most levered, one of the most levered in the world to real estate by a wide margin. And real estate has gotten trounced, and they have a demographic issue, as we talked about in segment 1, that is actually decelerating faster than anywhere else in the world. Plus, so you have the most spare square footage in history, in Chinese history, and you have the worst demographics in history, or declining demographics in its history. So again, all of these things result in a huge problem for future economic growth, which is where we continue to see a lot of this hindrance. Given this shows that decline, we think the decline, and I think Beijing is a great example, how you kind of get to the lows, and then you just kind of bump on the bottom. Like Chongqing, something similar, where you bounce, but you're still really off what is normal. And that's something where, we think things are going to kind of materialize over the next couple, let's call it the next 6 to 8 weeks, when you look at underlying activity. China in general, the 1-year loan prime rate stayed flat. The 5-year loan prime rate stayed flat. Swift global payments slightly, flattish. It's just we see a lot of, again, there's not a lot of impetus to do additional PBOC type easing right now. So Lou dropped more clues for what that can be done for the property sector. Policymakers are mulling new measures to improve the industry's balance sheet and boost market confidence. But it's okay, so you boost confidence, but are you still selling that square footage? Are you still building the square footage you were going to? The demographics holistically for the future are moving against you. So where are you going to spend all of this money, and with what? Again, they're trying to kind of hype a lot of this for, oh, well, just wait, 2023 is going to be a better year. It's like, well, it could, but it could also just be more of the same. And the Wall Street Journal scooped He Lefeng, the current chairman of the Macro Planner, or the NDRC, who will take over for Liu, is mulling a 2023 growth target of over 5%. So they're saying that China is going to grow over 5%. So year on year, okay, maybe, you should see some bump because things got pretty problematic. But he has reportedly already called for policies to kickstart the domestic economy, including boosting the property sector and rebuilding confidence among entrepreneurs. So you want to incentivize entrepreneurs, but you still have a lot of restrictions around entrepreneurs. You still have a restriction in terms of and cost for someone who's trying to start something else. And when you look at Xi has talked about common prosperity, which is taxing some of these entrepreneurs and again, distributing some of that wealth to drum up local consumption. So a lot of this kind of flies in the face of where things are headed. So could we get a bit of a shift in Xi's mindset of getting more party-centric and more entrepreneur? Because entrepreneur is less communist. That's less party-centric. That's more individualistic, which is, again, some of those struggles and how do they balance that. All signs over the past couple of weeks indicate policymakers are about to go all in to support economic growth in 2023. And then we'll have more of an idea of some of these readouts in general on economic work as we go forward. But in the meantime, Chinese sales manager index has fallen further negative. And as you can see, it's back to where it was in 2019. Business confidence is actually the lowest it's been going back to 2015, worse than peak COVID. Market growth is worse than peak COVID. Sales growth is flattening, prices charged coming down, staffing indexes turning lower again, leading more towards unemployment, and profit margins still negative. So, realistically, when the world economics, there's really not much to show from a lot of growth perspectives. So as you see the law of diminishing returns really biting China, you get an idea that the sheer size of the stimulus has to be aggressive. And is there an ability to do that given the fact that China is already sitting at over 300 times their GDP, and that's at assuming GDP at elevated levels. So as GDP falls, that leverage, that ratio only gets worse and becomes a much bigger problem. And then China floor space sold and consumer confidence, again, floor space selling is coming down. Policymakers understood that growth is below normal and became a major issue. Biggest challenge is the very weak confidence, no reference to common prosperity, and little mention to COVID, shift to living with COVID. So Chinese real GDP, you're starting to see that roll over, and realistically, it's going to get harder to bring growth back to a potential of over 5%, the boost domestic demand, consumer and business sentiment. Consumption is a problem. So again, they say these things, but the consumer is tapped out. The industrial side is tapped out. So who's going to take down this additional debt and this support unless it's just a straight up free money, which is a limitation that they have because they've given so much free money over the last 15 years, making that difficult to kind of manage. Then you go down kind of that line. So Japanese manufacturing came in at 48.8. Services bounced a bit to 51.7. But you're starting to see, again, a lot of this weakness filtered outside of just China. So how is China going to do this with a weakening global backdrop? So, ASEAN nations are getting worse, not better. India, same. Japan, same. South Korea, same. Europe, US. So who's the buyer of Chinese stuff to do this because the local consumer could bounce, but it's going to be much weaker than it ever has been and fall well away from what the pace was pre-COVID, just because people have now lost all of their money in real estate. They've lost all their money in the housing and the home they own. The unemployment is uncertainty. So I say that because China exports a lot to Japan for intermediary goods, raw materials that get turned around and sold into the U.S., which again kind of creates a lot of these underlying issues. And we had Japan, the bond yields spiked to that 0.41%. And if you look at in basis points, this is one of the largest increases we've had going back to, the last time it was like this was in early 2000 during the tech bubble pop. So you're seeing a huge issue. And again, this is reverberating down and all of this is happening. And the 10-year isn't even to the upward band that the BOJ set up. So you get an idea of the problems that are going to continue to materialize over this time. All the while, South Korean exports are flattish when you put it on a dollar level. But then when you look at on the preliminary basis on just volume, well, exports are down negative 8.8 and imports are bounced a bit at 1.9. But that drop is not something we see adjusting given all of the backdrops we talked about with China, the US, the G7, the OECD nations. It's just where we're going to see some of those additional slowdowns, which Taiwan is also seeing. Taiwanese export orders by dollar value dropped well below 2021, 2020, and is coming will fall closer to where it is. And total orders were expected to be at negative 12.8. Instead, they came in negative 23.4. That's something that we haven't seen since 2008, 2009. So we're well below COVID drop, which again points to more problems when you look at the Asian theater into the US market. India was no different. Exports year over year came in at 0.6, imports kind of flattish. But India monthly trade, you see that fairly sizable rollover. And that's where we see a lot of friction on the Indian front and things getting a bit worse when you look at where things are trending and how India is trending into next year. Again, it's still the bright spot. It's still an expansion, but we do think it goes into contraction as we head into Q1. India's imports cooled in November, both including and excluding oil, but exports are also falling as the global economy slows. External imbalances may have peaked, but a durable reduction in the current account deficit isn't around the corner. The rupee still looks expensive. So again, you're still going to see a lot of softness coming through, which is why we think India, just based on relative value, has the most to fall. So that's what we have for you today. We hope you have a great holiday weekend, an exciting new year. So I'm now done for the year. I will see you the first week of January. And if you have any questions, as always, you can find us in the comment section. You can email me, find me on Twitter. And we hope you have a great holiday season. Thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.